Good day all. Ira Epstein of Linn & Associates with your SPDR ETF wrap-up, and this is for Wednesday, the 29th of July, 2020. Well, 2 more days, month ends. We saw today the FOMC announcement and Fed Chair Powell's speech. I walk away with the impression that the Fed might be looking at longer dated securities to start targeting those to keep the rates down, which means benefits for mortgages and anything tied to long-term rates. I walk away with the impression from what I heard, they're not even thinking of raising interest rates. They're more concerned that COVID isn't getting cured and the flare-ups that keep coming on in originally the summer months where we were supposed to get a bit of a respite isn't occurring. More places shutting down, and I'm fearful that come September we're going to hear more QE talk if things don't improve or we don't find a vaccine and or a treatment for COVID-19. I walked away with all that. Tomorrow morning we get the GDP for the second quarter. It's expected to be the biggest decline on record, 34%. We know that that's the shutdown decline. We understand what it is, and the market, well, it's doing well right in front of it. So let's take a look at the charts and see the action of the day. Let's first go to the charts. I like that. Sideways. What's one of the things that I came out and told you recently? So the market was up here. I said, I'm getting a change in the market. And we're starting to see that this market's lost the bullishness that it had along with the QQQ. Let me explain it. We saw for the first time that the market back here, right on this day, the market had higher lows, higher highs, and then you went through this low. When you did that, the market set itself up at that point with a pattern of sideways action. With today's action, you again got higher lows, higher highs. You went into bullish action again today. You didn't have that yesterday. Yesterday, you had a pattern of lower highs, lower lows, and what the market should not have done is taken out the high, and that high was 106.97 from Monday. When it did that, you put into place higher lows, higher highs. To negate the bullishness, you've got to take out 105.53. Bulls grab control on the basis of the swing line. In terms of moving averages, remember what I said. The 18-day average is a line in the sand. That's the battleground. What else have I been telling you? If we take a look at these lows, each time we've gotten to them, you've exceeded them a little bit, but overall, we've looked back within a week or so and the market has been up and over it. I know I've been saying it and I'm saying it again. I want to see proof that something has changed. Until it's changed, I'm nervous. Now, you finished today 107.14 under the 18-day average. So while the swing line is up, the bias didn't turn up. Close over that and the bias is back up. What would be the upside target? The upper Bollinger Band at 109.55. Should the market fail here, because it made a higher high than it did here, you can't get into a downtrend. You'd have a higher high, lower and low pattern with a target maybe back to the 104.82 area, the lower band. In the technology sector, as we come in, I want to come here back here, that was with just Bollinger Bands. In that tech sector, when I add the slow stochastics and momentum, what's the point here? You were pointing down until today's action. With this rally today, you flattened that out. It has not turned up. So we have the, if you will, the bias down because you're under the 18-day average. Momentum has gone flat, the swing line up. Tomorrow's going to be a very important day. If the market responds well to the GDP number, I wouldn't be surprised if I'm talking to you about the upper Bollinger Band. Act poorly, the 104.80 area. In SMH, you're at a big resistance point. I'd be very, very cautious. You're overbought, trend is up, but fighting an upper Bollinger Band, you do it. Be my enemy. I won't do it. That's not a smart move. In addition, this isn't what I call one of those pipe actions where you're building a base. So I'd be a bit nervous here. I think the smart money came out of a lot of that. In XLI, we are still looking at a pattern of higher lows, higher highs. Where's the resistance? Look at this gray number, 200-day moving average. You ran into it here, you're into it again. That's not a reason to be bearish. It's a reason to understand the resistance. You have an embedded reading. You've been maintaining it. If we can clear this, the next hurdle 74.20. Should the market get through 2 days ago's low right here of 71.40, you could start the market back to the 18-day average, close under that. What would happen? Well, if this was as high as we got, you could turn bearish. A lot's going to depend tomorrow on what that GDP number says, okay? So we've got to keep an eye on that. In the tech sector, PYPL, and it's not something you smoke. This is the sideways action. You're in a pipe. So just think the spring, which is price, is whipping like this in this area. And as I told you, people get churned up in this. I used to be one of those. So I learned to just walk away from these pipes. The longer they go, yeah, you can take some strategies, buy puts, buy calls, buy a put, write a put under it, buy a call, write a call over it. My problem is in all that option strategy stuff, I've never in my career been able to time it all right. So I find futures, I'm right or wrong, a way better vehicle, a truer vehicle. I'm not interested in deltas. I'm not interested in the thetas. I don't want to know the burn rate each day. That's for the Nigerians. They're way better than I am at that. In QQQ, when we take a look at the high today, you got to 260.66. So we have a higher high, higher low. The market finished the day, though, under the 18-day average. Sound familiar to XLK? Identical. They're like track each other. Close over that number or get up and stay over it. You're probably going to make a run or attempt a run, maybe is the right wording, to 266. Get back under 256.51. You put in play the lower Bollinger Band. But something else is happening. We're in the early development of a pipe. You're starting to bring this number sideways, this one in very narrow action. We haven't done one of those sideways actions since March. This could be a change in the market makeup. In the emerging markets, you can see that you've still got your momentum pointing up. Both numbers were over 80, both over 80 the day before and the day before. That's an embedded reading. It's bullish. But I hate the narrowness of these bands. Support is strong at the 63.16, the 18-day average to the 200-day average at 62.91. But to get there, you have to break the pattern of higher lows, higher highs, and you might even lose the embedded reading. Therefore, if this market's going to make a move now, and you're playing it for that, it's got to get right up to that Bollinger Band right now. Start getting under this number right here at 63.65, and the chart action can get ugly on you. In GLD, you've taken what I call one of these trades that you're just running to the upside. And you're getting to the point where you're getting a number of consecutive days, more than the norm, over the upper Bollinger Band. You've done it in the futures, you're doing to it here, same thing, and it's got the embedded reading. This is just a really powerful bull market, and it's not even giving you an opportunity to buy under the Bollinger Band. When it doesn't, you don't do anything. In the gold miners, it's allowing you to buy. The question is, do you want to buy? I think today the pros bought this market. I think they bought it on this break. There's a key moving average that is in my end of the day Spider ETF video for paid subscribers, and I talked about that yesterday afternoon, and I think today was the day they bought, and I think that they're going to be looking to see can they get out at 44.20. In TLT, well, you've got your embedded reading. We're done with Fed talk right now. Now the question is the Fed going to start doing what I suspect they're going to do? Doesn't mean I'm right, by the way. What I suspect, I think they're going to target a bit longer instruments. Now, is it 20-year plus? I don't know, and that relies on this to a big degree. So we're going to have to find out. You had today an outside day down. If you take out today's high, because it's an outside day down, there's an exceptionally strong probability that you're going back to 171.11 like that. As long as you have the embedded reading, I think the pros don't care about the outside days. I think they're buying the breaks in the market. Lose that reading, I think you go back to the 18-day average. FXE, need I tell you any more? Gorilla glue trade. Every day practically you're hitting this. On the futures, you're exactly there. Are you there completely on this? No. Some of the days you're just gapping above, then you try to fill back in part of the gaps, but you're not doing a great job. And the reason is the futures and the cash market in Forex trade nearly 24 hours a day, 23 hours from really Sunday night until Friday afternoon, 23 hours a day beginning then for the futures and 24 hours for FX markets. So if you get moves, you don't fill them necessarily here. This market looks at what the futures are doing. The futures look at the FX to see what it's doing. They all work in unison. Very powerful until it's over. It ain't over. Now, I put out my morning futures video. If you're an FX trader, if you're a SPDR, an ETF trader, any of those, forget futures. You want to know what those futures are doing, because if you think once you're into these ETFs that are based on energies, currency markets, the metals, that they're not looking at the futures, where have you been? That's what they're looking at. And if you want to keep up with it, I allow you, I help you in the mornings. I go through these charts. I'm working with you, showing you what's going on in Asia, what's going on in Europe, where we're at in America, what the markets look like here. Because you don't open till 8:30 in the ETF SPDRs, maybe that's the edge you need for your thinking. That's what I'm talking, for your thinking and your strategies for the days. I cover the markets in this exact sequence, 40 charts at a time. There is a pull bar on the bottom if you're on our website, and you can pull with it. If not, and you're using my handheld, you can always back up, but it won't tell you what section. You'll have to see how far you pulled back. It's so much easier on the website, and it's a layover on the videos that we build. $7.95 to see if it makes sense for you. How do you get it? Go to our website, www.iraepstein.com. Under the word research, it's all explained. Give it a sign up. There's no contract. You like it, terrific. You don't like it, don't continue. Can't be simpler. $7.95. And when you sign up for this or my SPDR, you're going to get free access to my webinars. They're starting next Sunday, not this Sunday. We decided to give it one more Sunday as we're working on a new piece. Zoom helped us, and they told us what we have to do to get certain of our paid subscribers in for free. Non-subscribers, non-paying subscribers are welcome. You're going to pay an entrance fee to get into the live webinar, and if you want to see the recording of it, which you can, it'll be on the website at a slightly higher fee. So you get, if you come in live to ask the question, see what's going on, should be a pretty much fun time for you. So you get that, you get the weekend videos. Remember, on the weekend, on Saturdays, I now put out weekend videos. What are they? That video is for the longer term trader. It's just weekly charts, 40 of them on this, 35 I think in the SPDR ETF video for the longer term trader, where to have the stops, the entry, the exits, profit objectives. A lot of people don't want the day to day, they want the bigger picture. I give it, all included in these. I'm Ira. You have a good day. I hope you join us. Take care.